Hello, financial freedom fighters. John Thorman here. I'm excited to be back with you today to talk about tax-free retirement plans and to continue our conversation that we started last week. As I mentioned, I want to do a short series here on addressing these alternative retirement plans and go over their major benefits and features so you can understand them and see the value and how they might fit into your own personal retirement planning. But I'm excited to talk about these with you, and I want to begin by thinking a little bit about the ideal retirement plan, okay? So I ask this question to people all the time, so think about it with me if you would. If you were to design your ideal, the perfect retirement plan for yourself and your family, what would it look like? What are the characteristics or the attributes that you would want to have in this retirement plan? Let's list the top 4, okay? And pretty consistently across the board, every time I ask this question, I get the same answers. The order will change, but I get the same answers. So, the top 4 characteristics of the ideal or perfect retirement plan are, number 1, tax-free. Right? Everybody can agree with that. We don't want to pay taxes on our money. Number 2, we want to have good growth on our money. So good growth rates. Number 3, we want safety of principal. We don't want to lose our money. We've seen that happen too many times, right? 2008, 2000, 1987. We want to accumulate wealth without risk of loss, without fear of losing up to half of our portfolio in the next stock market crash. Then number 4 attribute is liquidity. We want to be able to access the money if or when we need it without fees and penalties and, paperwork nightmares and all that kind of mess. It's our money. We want it when we want it. Does that make sense? Would you agree that those are the 4 ideal characteristics of the perfect retirement plan? Tax-free, good growth rates, no risk of loss, and liquidity. Okay? So the plan, this alternative, this tax-free retirement plan that we're going to be talking about has all 4 of these attributes. That's what makes it so amazing. So we're going to explain them over the next few weeks and contrast that with the traditional option that everyone is being sold, like a 401k or 403b or traditional IRA or some other tax-deferred retirement plan. Because there's problems with those and people aren't really addressing them. So we're going to address them. We're going to dig into it and understand it and show you what your options are, okay? So while we're talking about tax-free retirement plans, last week when I introduced this series, I talked about the importance of this tax-free option. And within a day or two after I published the video, we saw on Bloomberg.com that President Biden is looking and planning at the first major federal tax hike since 1993. Major tax hike since 1993. This is a big deal. Of course, I didn't have any crystal ball. I didn't know this was coming out. I just said that I believe tax rates are going way up for several reasons. I don't want to go into it all. But here it is, and we're seeing the evidence of that happening, and I believe this is just the beginning. But what the report said was that they are looking at increasing the corporate tax rate from 21% to 28%. That's a large increase. That's significant. In addition to that, they want to remove the current advantages that you get from capital gains, long-term capital gains, and from dividends, because you're taxed at a much lower rate for those than you are at ordinary income tax. They want to get rid of those and tax you as ordinary income. So that would be a huge tax increase. And then they want to take the top rate and move it from 37 to 39.6. So, that's what they're kicking around, all these different numbers. But however you slice it, federal tax rates are going to go up, and I think they're going to keep going up. If you look at the history of the top marginal income tax rates in the United States, you'll see there's decades when they are over 70%. So we've got to do something about that. But also in the Bloomberg article, it said that there's several states that are eyeing tax increases as well. So it's not just the feds looking to go into your pocket for more money, the states are as well. So we really got to understand what's happening, but we're going to have to do something. And either A, you make the decision to do nothing, right? Because that is a decision. You do nothing and you take whatever you get, whatever comes your way. Or, we can see the writing on the wall. You do something different, right? You take action and you devise a new strategy to arrive at your desired retirement goal and income objective that will protect you from this environment and from rising tax rates. Understand that the largest expense that you will have in your lifetime is probably your taxes, right? It's not going to be your mortgage payment, your housing, your rent, whatever. The largest expenditure you have is going to be taxes. And I want to help you understand that and find ways that you can protect yourself and minimize this tax burden in your retirement when you're older and aren't working or generating as much money anymore, but are living on more fixed income, living on the yield from your investment accounts, and find ways to minimize that tax burden because it's going to be significant. So I'm going to be talking a little bit too over the next few weeks on several financial principles that are good rules to live by, if you will. But these financial principles are helpful and are consistent. All the financial advisors are recommending them, the top financial planning books, all that kind of stuff. One of these financial principles is that it doesn't matter as much how much money you make. It matters how much money you keep. And this tax-free retirement plan option is consistent with following that financial principle, okay? Now, that principle is used in two ways. One, we implement that principle when we're doing our budgeting, right? When you sit down and you plan how you're going to spend your money in advance so that you're directing the money and you're putting it to work and being intentional about it. And back, years ago when I had my financial practice up north, we had this little saying, and it was like, something to the effect, if your output exceeds your monthly income, then your upkeep will be your downfall. Okay? I'll say it again. If your output exceeds your income, then your upkeep is going to be your downfall. So that's the financial principle that we're talking about. It doesn't matter how much you make, it matters how much you keep. You want to keep money every month. You have leftover money so that you can keep moving forward, right? Well, that same principle also applies, I believe, in keeping more of your money, your after-tax money, in your pocket. So what can you do to minimize your taxes? This is an important financial principle. What can you do to minimize your taxes? Not just now, okay? Don't be lulled or duped into believing that getting a small tax deduction right now is in your best interest, because all these 401ks and 403bs and IRAs, all these tax deferred retirement plans, yeah, you get a small deduction right now, but that is nothing compared to the taxes you're going to pay on that money that has compounded and grown over decades, right? You're going to have a large sum of money, and every dollar you withdraw out of that in the future is 100% taxable as current income. So the small little bit you save on taxes now cannot compare to the enormity of the tax bill you're going to face in the future when you withdraw money out of your tax-deferred retirement account. So we got to consider the principle. It matters how much you keep, and we got to keep more after-tax dollars. We got to keep more of your money from the tax man so that you can live on it. Right? Consider this. If you have two accounts, you do the traditional 401k IRA option over here, and you accumulate $1 million for retirement. Good job, got $1 million. But if the government taxes it at 50%, man, you only have $500,000 to live on. But if you put together a tax-free retirement plan and you accumulate $1 million and there's no taxes due, then you've got $1 million to spend. You got $1 million to live on. You have twice the after-tax money to maintain your standard of living in retirement. That's a way better deal, right? Which would you rather have? $1 million tax-free or $1 million that's taxable at maybe 50% or maybe even more? I mean, it could be really bad. So that's the thinking. That's what we're going for here. How can we position you so that you've got more disposable income to spend in the future by minimizing taxes? And this tax-free retirement plan option we're going to dig into over the next few weeks allows you to do that, and it's super compelling. And as I said, it incorporates all 4 of those ideal characteristics of the perfect retirement plan, right? Tax-free, good growth, safety of principal. You're not going to risk losing half your money in the next stock market crash. And it's liquid. It's accessible. There's no penalties from the IRS to access your money if you come into a situation where you've got to get to it. So that's it for today. I think a little short conversation here today. I am excited about this and going over more of these details over the next few weeks. So come back. We'll address the next issue in one of these 4 ideal attributes of the perfect retirement plan, and we'll go through them the next few weeks. But please, if you have questions, drop it in the comment box. Be sure to subscribe to the channel and hit the bell so you get notified of the next video when it comes out, and share it. Let's get the word out and help other people know that there's an option and start to understand it so they can make the best financial decision for their family. Okay? Thanks, guys, for tuning in, and I look forward to seeing you real soon on another video. Bye-bye.